It's the first spot within the market that we're seeing what I would call widespread signs of upside exhaustion. I would say right now, I think there is a commodity bull cycle underway, and you saw it in gold, you saw it in silver. It's there also in copper. I see some signs of a turnaround in natural gas. We think this is a lasting bull cycle for commodities, and we think that's different, right, than what we've become accustomed to over the past few years. So we're excited to see that.
On the Spot with Michelle Makori is brought to you by Swan Bitcoin.
Hello, I'm Michelle Makori. Thank you again for joining us. The S&P 500 and the Nasdaq hit record levels this week, boosted by data showing signs that inflation is somewhat cooling or staying flat. But how much room is there left to rally in the markets? Well, my next guest says that there are signs of exhaustion, suggesting that the second half of the year will be more choppy and volatile, and advises caution for investors navigating what's ahead. Here to discuss what to expect in equity markets, Bitcoin and gold is Katie Stockton. Katie is the founder and managing partner of Fairlead Strategies, an independent research firm and investment advisor specializing in technical analysis. She's also the portfolio manager for the award-winning Fairlead Tactical Sector ETF, TACK. And with over 20 years of experience on Wall Street, Katie has provided technical research and advice to institutional investors, including as chief market technician at MKM Partners and as part of the technical strategy teams at Morgan Stanley. Katie, welcome to Kitco. Very good to have you with us.
It's great to be with you, Michelle. Thank you.
All right, Katie, you are a technical analyst, but we did have some fresh fundamental data and information come out this week. The Fed keeping its key interest rate unchanged and signaling that just one cut is expected before the end of the year. We also had U.S. consumer prices coming out flat in May on a yearly basis. CPI increased 3.3% after rising 3.4% in April. Now, S&P 500 and Nasdaq hit new highs after the Fed meeting. They're still trading near that range. So let's start off with a broader picture. What are the technicals telling you about the S&P 500 now?
Well, the market definitely welcomed that data so far this week with the S&P reaching a new high. We do have what I would describe as a very narrow tape, meaning that the participation on the upside has not been great. We did see the favorable reaction, but breadth has really contracted, and it's been to the benefit of the likes of NVIDIA and Apple, and to the detriment of anything that isn't really exposed to those types of mega caps. And that would include any equal weighted benchmark, S&P 500 equal weight, and small cap benchmarks like the Russell 2000. So it's really a bifurcated market at this time. That's not necessarily a bearish takeaway, but it does present a challenge to the S&P 500, which is really depending right now on the gains from those large cap technology stocks, the mega caps in particular.
Right. Now, typically the adage is sell in May and go away. We've had a solid June. So is it sell in June now? You mentioned that you do see a pullback in the second half of the year, potentially. Talk us through that, what the charts are telling you there.
Yeah, and it's all about reconciling the time frames. We do believe that a pullback is likely in the near term, but we want to make sure to frame that within a bullish context. The S&P 500 has broken out, and breakouts tend to foster additional upside momentum. And indeed, we've seen that already short term, and we think it will be the case intermediate and long term. The long-term metrics still point higher. We can arrive at a big measured move objective of about 6,100 for the S&P 500 based on its last breakout. So that's what we want to keep our sights set on in the future. And yet more, sort of near term, there are those signs of upside exhaustion that we've got our eyes on. It doesn't mean you go and reduce exposure broadly necessarily, but we've been recommending just over the past 2 weeks that our clients consider short-term market hedges from a top-down perspective just to manage risk throughout a pullback. Or perhaps if they're considering adding exposure, they might want to wait until there's a better buying opportunity. And it will feel a lot different, I think, than what the market feels like right now, which of course is something that has very strong sentiment, right? We have a very sort of bullish feeling tape right now. And unfortunately, when we get the buying opportunities, they don't feel that way. They feel a bit more dismal in terms of market sentiment from a contrarian perspective. So that's what we're holding out for, is a little bit of a hit on sentiment in the near term to give us a better buying opportunity. And to your point on the increased volatility in the second part of the year, that stems from our thought that the volatility index, and I can pull this up for you, is moving from a lower volatility cycle into something that's showing higher volatility potentially for the next even year or so. And this isn't overtly bearish for the S&P 500, but it does suggest that we'll see an uptrend that is more volatile, so dotted by more corrective phases. And it could be a little bit of a harder environment with that in mind. If you have the charts up, I can show you on the VIX. This is a long-term VIX on a monthly, and you'll see back in here, this is our low volatility cycle. And yet we've seen the long-term metrics start to turn, suggesting that we'll see this cycle give way to something that shows higher volatility. And once we have that, of course, we'll have to be a little bit more attuned to risk management.
Right. Now, you have said that you see small caps, which have been underperforming, which obviously shows a lack of market breadth behind this recent push higher. But do you see that changing? Do you expect that to continue?
Unfortunately, not really. We're still looking for underperformance from the small caps versus the large caps. And it comes from the ratios that we track. When we look at the Russell 2000, which is our primary small cap benchmark, we've seen that there's a breakdown in this ratio versus the S&P 500. You can see the ratio has been really very weak. And when you see the breakdowns in the ratios, that does tend to exacerbate the downtrend. So we're still assuming that we'll see underperformance from small caps. In absolute terms, if you look at the Russell 2000 index, it does have positive long-term momentum. It's of course not as strong as the S&P 500, but it's strong enough to suggest that indeed the range or sort of bear cycle that we've emerged from is in the past now. So we are bullish on the Russell 2000 index from a long-term perspective, but we also are expecting it to underperform the S&P 500 to a greater degree.
Over what time frame do you see it underperforming? You say you're bullish on it long term, but short term you see underperforming. Give me a sense of what time frames we're looking at here.
It's a good question, and it's a long-term downtrend. You can see that in this yellow line here. This is the 200-day moving average of the ratio. So it's a long-term downtrend, and within that context, we have an intermediate term breakdown. So I would say intermediate to long-term, we're going to make the assumption that it will continue. Of course, if we see some stabilization and counter-trend signals arise, then we'll feel more comfortable with it. But we don't have those at this time. And the charts will not be ultra predictive in that sense. We don't know where this is going to be in 6 months, as an example. But it will help you stay on the right side of these trends, which of course is lower in relative terms.
All right, let's talk about the Nasdaq. Nasdaq 100 up over 18% year to date. What signals are you seeing there?
The outperformance has really been so remarkable from the Nasdaq 100, and that is attributed mostly to those same mega caps like Apple and Nvidia and their outperformance versus most other stocks. The best momentum has been here, the best relative strength has been there. But because of that, it's the first spot within the market that we're seeing what I would call widespread signs of upside exhaustion. And by that, we actually have a way to measure this, and it's something called the DeMark indicators. At the risk of getting a little too technical here, you can see this is the monthly chart of the Nasdaq 100 index, so a very long-term view. When you see this 13, which is one of the DeMark indicators, that is a counter trend indication. And unfortunately, the last time we had that was back here ahead of the bear market cycle in 2022. It doesn't mean it's an outright sell signal where we reduce exposure again broadly, but it does have us effectively on the lookout for any kind of meaningful loss of momentum. And we would be more mindful of that loss of momentum when it occurs. And we have these same signals for the Nasdaq 100 across the time frame. So it's on not only the monthly chart, but now also we have one on the weekly chart here. And as of just today, which is Thursday the 13th, we have one now also on the daily chart of the NDX or Nasdaq 100. So this is something that has us a bit cautious near term, just suggests that we'll get a consolidation phase underway. And at the end of the day, that should ultimately be healthy for the longer term uptrend.
All right. But when you say you've got these DeMark indicators showing exhaustion, are you seeing that confirmed with other technical analysis indicators? Does that usually kind of what consolidates the theory for you when you see other indicators, other patterns showing the same thing?
It's exactly right. It's a very good question because as a technical analyst, we're always having to cross-reference our various indicators. And with that, we either get more or less conviction in certain signals that we have. So what gives these signals a little bit more, I'd say, weight would be the fact that we do see them across multiple time frames. The momentum, though, is still obviously strongly to the upside. So we haven't seen the confirmation from our momentum gauges, and that is important. And that's why we're saying, let's keep an eye on these. Let's not see them necessarily as outright reasons to take profits or reduce exposure broadly, but let's keep an eye on them.
All right. So you're not taking profit off the Nasdaq 100 at this point. You are just seeing indicators that we should be a little bit more cautious, perhaps, going into the fourth quarter? Is that when you expect to see a little bit more of a pullback?
I actually think the pullback could be imminent off these signals. So it just tells me not necessarily to take profits, but to wait to add exposure, right? Because we still believe in the long-term trend.
So long-term bullish, but before you bolster your positions, you do think that you need to wait, see if there's a little bit more of a pullback. Let's talk about some of these two big drivers of the NASDAQ. And of course, that's Apple and NVIDIA. Let's kick it off with Apple. It's been a solid week for Apple after it came out with Wall Street's two favorite words these days, AI, artificial intelligence. We saw Apple up more than, 9% over the past 5 days, market cap at over $3.3 trillion. What are we seeing there? What are you expecting?
Well, it's been really interesting to watch this week as a technical analyst. We're always looking for breakouts and breakdowns. And you can see on the weekly bar chart of Apple, this is a pretty major breakout potentially for the stock. It had been range bound, defined by resistance here, which was around 198 on the chart. It's now decisively through that resistance level. We, as a part of our discipline, we always wait for 2 bars or 2 weeks in this case above a resistance level to confirm a breakout. So we're sort of treading cautiously here and waiting to see if this breakout holds not just this week, but also next week. And that would then suggest that Apple has emerged from its trading range and has more upside. You can arrive at a measured move objective, which is assuming the trend will basically continue off of that early sort of 2023 low. And it would project to about 240 for Apple, which is still pretty solid upside from here. So we're interested in this breakout, assuming it's confirmed. And yet we probably would wait for a little consolidation before adding exposure.
All right, NVIDIA. Obviously, that's been the big one. We had that 10-for-1 stock split. NVIDIA doing very well since then. I mean, it's been one of the most phenomenal stocks this year. Over the last 2 years, it's up, 42% this month alone. People are always like, is it too late to get into NVIDIA? Have I missed the boat on NVIDIA? What are the charts telling you, Katie?
Well, the momentum's still obviously there for NVIDIA, just like it is for the Nasdaq 100 index. It does share in some of the same signals that we highlighted on that chart. You can see one right here, one of these 13s, which gives us a little pause in adding exposure here too, given the first major support is around 97.40, which of course is significant downside from current levels. So with the distance to support and with the counter trend signal, those who have had nice gains and believe that the stock is fairly valued might think about taking some exposure off the table. But we don't have a strong sell signal at this time in NVIDIA. We would simply say, it's poised to consolidate, should ultimately lend itself to a better sort of setup for a buying opportunity. And we believe in this long-term trend and its momentum, but we also are not inclined to buy stocks often into parabolic up moves like we've seen from NVIDIA. It's hard to ignore. Of course, it's been such a contributing factor to the major indices. But we worry a bit, once NVIDIA loses that upside momentum, that it could impact those major indices here in the near term. So we'd prefer to be, holding off on new positions, holding, I'd say, the bulk of existing positions, and just letting the stock drift into us a little bit.
Okay, so you are not selling at this point, and you're not buying at this point with NVIDIA.
It's actually, the sell decision, of course, comes from not just the charts. There's much more to consider there in terms of taxes and your overall positioning in your portfolio, right? But if it were me, I would say I'd probably be holding at least most of my position, maybe reducing partial and looking for a better entry if I were to add.
Okay, our viewers always want to know what is going on with Bitcoin, Katie. You've got the charts that break it down. We did have Bitcoin approach its record highs of about 70,000, above 70,000 at the beginning of June. It did drop off to the Fed announced, falling below 67,000. It's recovered since then. Guide us through what we're seeing with Bitcoin now.
It's a trading range, and Bitcoin never fails to excite us. And yet this is a kind of environment that really is more neutral from an intermediate term perspective. So at this time, we're just holders. We believe in the long-term uptrend here. You can see it in this nice chart. You can see that moving averages have pointed higher long-term, and this is our cloud model, the shaded area, and that's pointed higher as well. But we're in a range as the gains are digested off of what was an overbought condition. It's healthy, we think, from a long-term perspective, but poised to continue from a short-term perspective. So we're expecting a little bit more corrective price action from Bitcoin and from most of the altcoins alongside it. And with that in mind, we would just, sort of take a seat and just watch it and look for a better opportunity to add exposure if we weren't already there.
Do you see Bitcoin hitting a new high in the next couple of months, though? Do you see it exceeding that 73, 74 level with conviction?
I think, listen, I wish I knew where it would be in a couple of months. I think ultimately—
Or end of the year, whatever time frame works.
Well, I think it will ultimately emerge from the trading range to the upside based on what we're seeing. And what we watched to that end, we watched both the support and the resistance to help us manage risk. As long as the support is intact, that, of course, would suggest that the trading range is more of a consolidation within the broader uptrend. But we would put basically a stop loss below that support, which defines the bottom of the range around 60,000, just to avoid what could have been a more significant corrective phase, perhaps. And then, of course, if we see Bitcoin ultimately emerge from its range as we expect, well, then that's somewhere we might increase positions, or we might increase into like an oversold upturn, something like that on the chart. So it's a matter of watching the levels, making sure that the momentum gauges don't shift too meaningfully, and staying on the right side of that trend.
So you're calling 60,000 as a support level, yeah?
That's right. The 50-day moving average is basically in line, very close by for Bitcoin. So that's a minor level as well. And then the 60,000 level is a rough estimate of the bottom boundary, the range. So a level below which we'd be a little uncomfortable with that kind of breakdown by Bitcoin. So we have our risk metric there.
So if it breaks below 60, what does that signal to you then?
Well, it would signal a greater retracement. It wouldn't necessarily signal a bearish reversal, but it would suggest that rather than just, consolidating to relieve its overbought condition, that Bitcoin would need something a bit more significant in the way of a corrective phase. You can see, as an example, the cloud, which is another gauge of support, is still rising. So it's still reflecting that longer term uptrend, but there's enough of a distance to it that you could still see a more significant corrective phase within the context of that uptrend. So we hope to see the 60,000 level hold. We have indications that it will hold. But of course, if that changes, we'll respect that.
And what are you seeing on the upside here? What is your price objective that the charts are indicating?
We already have seen Bitcoin break out to new highs, and that's usually a bullish long-term development. It removes the chart or resistance from the chart. So that breakout yielded an objective close to 81,000 for Bitcoin. It seems even perhaps conservative based on the price history and how high beta Bitcoin can be. And yet, it seems realistic. So we're excited to see Bitcoin ultimately emerge from the trading range. And that would simply mean exceeding this high from March, which was just shy of 74,000. And that would free it up to make more upside progress in our sort of estimates. But that 81,000 level was targeted by the breakout to new highs. So we have that as our longer term objective.
Over more or less what time frame? You said longer term, but what's the approximate time frame there?
For us, the time frame is usually 6 to 12 months as our version of long term. Sometimes Bitcoin proves to do this sort of time compression, right, where longer term becomes more like intermediate term because it is so fast moving at times. But it still seems realistic within that time frame with the breakout having occurred back in March. So it would warrant a bullish bias over the next few months.
So, Katie, we speak to people across the board on Bitcoin and their price forecasts. Some are fundamental analysis, some are sentiment analysis, some are technical analysis. I want to get your thoughts on this. We have a technical analyst who has a record of being quite correct. He sees Bitcoin pulling back to 50,000 this year. On the flip side of that, we've spoken to a lot of people. We were just at the consensus conference, very bullish sentiment there. People in the space, they're saying Bitcoin hitting 100,000 by end of 2024, conservatively speaking. Well, what do you say to that? You're happy with that 81K there?
If any of them actually knows where it will be at year end, I would love to talk to them. You can see that our discipline and our methodology is more about risk management and identifying prevailing trends and when those trends might be exhausting themselves. That the uptrend does not appear to be exhausting itself to us. It appears to be taking pause. Mm-hmm. So we think a breakout is more likely than a breakdown. If we did see a breakdown from the range, I certainly wouldn't rule out the 50,000 level. It is a support you can see even looking forward towards year end based on our cloud model. But by no means would I predict that because the indicators on a long-term basis do point higher.
Right. Let's talk about the correlation that you have between Bitcoin and the Nasdaq 100. You've pointed out that ratio is very telling as well. Explain what you see there.
This is in our weekly cryptocurrency compass reports. We do dive into the relative strength work, which I think is really important as it pertains to Bitcoin, Ether, and also some of the altcoins. And then we try to identify themes that are relevant at this moment. And that includes this Nasdaq 100 correlation, which was topical in the past and appears now topical again. Hopefully you can see this chart here. The green sort of mountain that's growing there is the correlation between Bitcoin and the Nasdaq 100, and it's certainly grown to a relatively high level. And when that happens, it usually is a market for risk assets broadly. So not just Bitcoin, but equities and elsewhere. That is a little bit more corrective or under pressure. And that's because investors will treat risk assets as just that, riskier assets, and penalize most of them during that corrective phase. So you see the correlations increase. So indeed, the correlation would suggest that Bitcoin and the Nasdaq 100 are in sort of a corrective mode, essentially. We aren't really seeing that yet in the Nasdaq 100, but we are, of course, having seen it in the Bitcoin chart. So it's reflective of, I think, the corrective phase that's underway more broadly in risk assets. And it does give us a little bit of an edge, perhaps even when we come in the morning. We can look at the price of Bitcoin and evaluate its action because it's trading constantly, and maybe even get a leg up on our bias for the very short term for the equity market. So it is something that we can leverage in a way by saying, okay, well, we have this high correlation. It's there for a reason. And when we see Bitcoin trading off quite a bit and the S&P 500 futures are flat, well, it gives us a sense that maybe the futures will come under pressure.
So you're using Bitcoin now as a risk metric for equities, taking advantage of that correlation. All right, well, let's talk about gold, because gold obviously seen as the way to go when people are fearing things, gold, safe haven, store of value. Gold has had a phenomenal run this year. It did see a bit of a pullback, though, following the Fed announcement. It's at around the, $2,320 level per ounce. It did set at an all-time high of above $2,400 in May. What are you seeing in terms of gold's performance now?
Yeah, I mean, listen, we had another big breakout here. So Bitcoin reached new all-time highs, and so did gold. And the gold chart, we saw the breakout at the former resistance for those who watch it was around 2063. And we saw immediate upside follow through. And that's what you want to see. You want to see good upside follow through on the back of a breakout. It just enhances it. And therein lies why we wait for confirmation typically. So now, of course, we have a bit of a pullback underway, and it's not limited to gold. It's for metals in general, silver, copper. And they're pulling back off of what was an overbought extreme. And we see that as healthy, right? So it followed a major breakout to new highs. It followed a good upside follow through. It followed an overbought indication. So a pullback's only natural at some stage. We do think the pullback will persist in the near term for metals prices, including gold. But then we would look to add exposure once we feel it's maturing and we have our indicators to kind of keep on our side to that end. So we don't think the pullback is done yet, but we don't think it has a terrible amount of downside from here, and ultimately want to take advantage of that longer term breakout. The equivalent objective that we could arrive at using that same measured move projection is about 25.15 for the price of gold. And it may be conservative. It's not necessarily a stopping point, but certainly a reasonable objective in our opinion.
Okay, so 25.15 to the upside. Again, time frame here, Katie.
Oh, well, it's another long-term breakout, right? And it's, something that we think is more relevant probably for 2025. But, there's just really no way to know, where it will be at any given time. It just is as a price objective that is a function of the prevailing trend.
Are you comfortable calling a bottom for gold in 2024? What is your support level that you think we're not going to see gold go below?
That I would love to know, but I would say the support, there's minor support in line, and that seems in jeopardy of breaking. At the 2200 level, a secondary support. It's not really a major level either, but it would be a natural place perhaps for oversold conditions to return. So we have sort of our hope set on the 2200 area, but as mentioned, that former resistance that was cleared this year, the 2063 level, that's the really major level. We do not want to see gold below that level because that would bring it back below its breakout point. So we're not calling for that, but we would love to see 2200 hold.
Wait, below which level did you say?
The 2063 level. So that's
2063. That's a red flag for you if it drops below that.
That would be if it fell back below that, and even a breach of 2200 would be a little bit of I'd say setback for the chart. But the 2200 level seems to be promising in terms of where the indicators stand right now.
All right, you did mention that you're seeing a pullback in metals across the board. Let's talk about silver because it did have a strong move recently, rising above $30 an ounce, also slightly down post-Fed. What are you seeing there?
There's some signs of upside exhaustion for silver, which we'd already seen from gold. So it almost seems like it's following gold's lead with a pullback. And we think that the pullback here too will persist. And yet the downside seems somewhat limited because there is such good support. We had a good breakout too for silver. You can see it here on this chart. And even if it came into the breakout point, it really wouldn't damage the long-term bullish breakout. So we feel, the pullback should persist probably for a few weeks based on our indicators, but then we'll have an opportunity to take advantage of that weakness.
Okay, let's focus now on your award-winning ETF, the Tactical Sector ETF, TACK. Elaborate on what that is.
So it is a sector rotation focused ETF. It's designed to take advantage of sector leadership. And we do that through investments in other ETFs, the sector spider ETFs, things like XLK and XLY for those that know them. And we invest in them on an equal weighted basis. So we're trying to reward the sectors that have the best relative strength, even if they're a much smaller footprint than, say, the technology sector. And we have this very strict attention in our model, which is all based on technical analysis, to risk management. And we're interested, of course, in leveraging the upside of the market, but also we want to be very strict about limiting drawdowns because a lot of investors can't really afford those drawdowns, and it sets you at a much lower place from which you have to climb back. So it has a dynamic feature that if the sectors aren't really qualifying from a long-term momentum and relative strength perspective, well, then they're kicked out of the portfolio and replaced by a combination of what we would consider to be risk-off assets. And that would be short-term treasuries, long-term treasuries, and gold exposure, all achieved also through ETFs. So it has this unique sort of dynamic shift between the risk-on sectors, the risk-off asset classes to manage risk through those drawdowns. And our goal is to build on the returns of the market, but to do so with very favorable risk-reward metrics.
Okay, so what is the breakdown of the holdings roughly of the TACK ETF right now?
Right now, it has full sector exposure, which it's 8 sectors that we hold at 12.5% model weightings. And those sectors are probably the obvious ones to everyone's, the ones that have done the best of late. And yet, if we see a pullback unfold and it's enough to damage any of our longer term momentum metrics, we'll see that shift into some of these risk-off categories. But right now, it's running the full sector or full equity market exposure. It's a large cap, sort of balanced fund in that way at this time. But think of it almost as like a replacement for the old buy and hold type of strategy during which you'd ride those drawdowns all the way to the low. And it does something a little bit less than that ideally through this asset allocation. So we see it as a great alternative to buy and hold, and also a great replacement for sort of the old 60-40 type of portfolio, in that it has that dynamic element to it. But right now we're very bullishly positioned in TACK.
Do you see it, though, more as a defensive play, more of a safe bet?
Well, we do see it as somewhat safe in that it has that attention to risk management. And we do say, TACK is a fantastic core holding for investors who want that market exposure, but they care about drawdowns. And we have recommended to some of our clients and investors that during a very strong tape that's being led by technology, that they can go have, their technology stocks that they're so interested in, the cloud computing stocks, the NVIDIAs of the world, even some small cap exposure to add a little beta to their portfolio and, sort of leverage the momentum in those types of environments. But we really think TACK is a great core holding for those that want that exposure, but also have strict attention to risk management.
Right, because if we look at the performance, correct me if I'm wrong, TACK is up about 5% year to date compared to the broader S&P 500 up above 14%, Nasdaq above 18%. So is the thinking that it's a safer play in case there's a big reversal? Like which kind of investor should be looking at adding the TACK ETF?
It's interesting. The benchmark for TACK is actually the Morningstar Moderate Target Risk Index. So it's not the S&P 500 because of the components being inclusive of these alternative asset classes. And you're correct in that it's up about 5% year to date, and it's been additive to its benchmark by nearly 1%. In terms of total returns. So our goal in part is to outperform that benchmark, which I would assign is something similar to a 60-40 type of portfolio in the way it's constructed. So that's one of our goals. And we're excited to see it navigate different market environments. The outperformance was really very pronounced in the 2022 bear market cycle, in that the drawdowns were limited by more than half during the three major drawdowns that we saw versus the S&P 500. And that's very true to the model.
Right. So, Katie, are there technical indicators or patterns that you use in your analysis that you find to be more reliable than others? What do you find to be the most reliable or top most reliable indicators when you're putting together these charts in your analysis?
You're seeing a lot of them on the charts that I've shared today, the indicators that we use, most of which are available to everyone. Very easily, they can go online and find these indicators. The MACD indicator, for one, is a big part of our process. It's a trend following or momentum gauge. We're using overbought, oversold metrics. We're using relative strength inputs. For us, technical analysis is a day job. So arguably our model is a bit more sophisticated than maybe the average investors would be. But this is our bread and butter. It's what we do every day. And we really believe in, importantly, a systematic approach to technical analysis. It's really hard to derive the benefit of the discipline when you're just kind of seeing, oh, well, this sounds good, the next day. It's important to stick to the mathematical gauges that are going to give you that nice unbiased view of what's actually happening in the markets.
All right. So as we wrap up here, Katie, final thoughts. What is your highest point of conviction at the moment?
Oh, goodness. That's always a hard one because we look at so much, in our research. But I would say right now, I think there is a commodity bull cycle underway. And you saw it in gold. You saw it in silver. It's there also in copper. I see some signs of a turnaround in natural gas. A lot of the grains have turned the corner. So we're really kind of interested in that. And the one sort of missing piece has been crude oil, which has been range bound. But if that also kicks in, I think that will also exacerbate this cycle. So we think this is a lasting bull cycle for commodities. And we think that's, different, right, than what we've become accustomed to over the past few years. So we're excited to see that.
All right. Well, Katie, thank you so much for joining us. Appreciate your analysis. Very thorough analysis and your insights. Thank you so much, Katie Stockton.
Of course. Thank you.
And as always, thank you to our viewers. I do also want to say a special thanks to our sponsors, Swan Bitcoin. A reminder to our viewers that Swan has an IRA product, which allows you to invest directly in Bitcoin with your IRA. There's a way to set it up that you're basically buying Bitcoin on autopilot, which allows you to take advantage of dollar cost averaging. You accumulate Bitcoin into your IRA. Obviously, the tax advantage is there. Now, there's a link in the description with a special offer for Kitco viewers to help facilitate that process. So take a look at that. Thank you again for watching us here on Kitco. And remember, we love to hear your comments. So feel free to praise, whine, or just opine. And we do appreciate them. We do read them and we do acknowledge them. For me, Michelle Makori, and the rest of the Kitco team, we will see you again soon.
On the Spot with Michelle Makori is brought to you by Swan Bitcoin. Swan Bitcoin IRA. Your legacy, your way. Real Bitcoin, not proxies. Traditional and Roth IRAs. Fast, easy setup. Start now at swan.com/retire.